Let's start. Anyway, I put this thing together. I was hoping to have more participation, but I know people are busy and have a lot going on. Um, but I wanted participation because I always felt that interactive conversations during the course of talking about any strategy are really good for one simple reason. I'm going to unmute you, Mr. Stone. It's recording right now, and that's why I have you guys on voice. You're unmuted, Mr. Stone.
Hello.
That's how you doing, man.
I am good. Sorry, I'm a little bit late.
You're excused. Did you bring your excuse note?
Yeah, I brought
Your hall pass?
I brought a letter from my employee who said that I'm doing reconciliations.
Oh, what are you doing? Tax stuff?
No, I'm helping a friend of mine who owns a finance company, so he's got like 7 bank accounts, so I'm trying to help him figure it out.
That's a lot of bank accounts. So, anyway, good to hear. We just brought you up about your one experience trading credits being not as stellar as you might have wanted it to be. So anyway, the more people we have, the reason I wanted to do and it kept pushing people to sign up was more interactive. The better outcome it is for everybody because you just go through example after example and idea after idea, and you generate a lot of different views and strategy. You know, any trading strategy, whether it be a scalping strategy, credit spread strategy, swing strategy of some sort, technical analysis strategy, trading wedges or gaps. There's a whole bunch of different ways to do that, right? There's no one right way. In this particular class, I'm gonna teach sort of the classic 45-day open, 21-day or 50% close scenario. But we're going to build off of that. I'm going to talk about some alternative strategies. Arax is going to chime in and talk about a strategy he's been deploying recently, 0 days to expiration on the SPX, I think, exclusively, right?
Exclusively SPX.
Yeah. So we're going to talk about that. But one of the things, and I think everybody knows this, but I'll just say this really quickly, this is not one of these 1,000% runner kind of strategies. Your profit is set, your maximum profit is set right when you open the credit spread by the amount you receive premium in your account, right? So, if you're used to looking at debit spreads where, or even just a pure debit, like when we scalp, we're looking for $200, $250, $300 run on a contract, you're not going to see that here because once you've opened this contract, the maximum profit you can achieve has already been established, right? I want to go over what credit spreads are, and that would be my introduction to them. It's a strategy by which you open a particular spread, and in your account you receive a credit versus a debit in your account. So if you open up a credit spread that's for $100, your account now has $100 more in it than it was before you open the spread up, right? So we'll do that. So why do we trade them? We're going to go through that. Pretty simple explanation. Probability of profit is extremely high. What's the best time to use them? Because they're not always appropriate. And I'll also say this: they're not. There's some. When you guys are done with this, and of course, Arax, I know you really like them, so I don't expect you to say I'm done with these things. But I've had folks trade credits that they just don't like it. They don't like the whole concept of having $840 at risk for $160. $160 credit in your account that you can keep potentially, right? So we'll go through the strategies, the contract selection techniques, the ones I like to do, alternative strategies such as 0 day to expiration, weekly strategies, high delta plays. There's managers out there that play 40, 50 deltas, so like right at the money. Talk about the expected move and how to integrate it into your trade and the various risks associated with that. P&L. Because it's really important to understand the profit and the loss on these trades before you get into them. Because the first time people start looking at them, they're like, "What? I'm getting a $200 credit on a 10 wide spread, and I'm risking, $800 to make 200. Doesn't make any sense to me." So we'll get into P&L what are the key things to look for there. How to get out, obviously, is, in my opinion, I think it's 21 days or 50% on your classics. But I know for the most part you try to hold right to expiration, right, Alex?
Oh yeah, definitely.
So, and then there are times when your spread's going to get in trouble. And
yeah.
one of the things that, one of the benefits of having these is that, first of all, you can be wrong and still be fine on the trade. But if you get really wrong, you can change the spread, change the expiration and the strikes in such a way that you keep the same credit you originally opened on the trade, and put more time into the trade and wait for it to work in your favor. Okay.
Wow, so many examples of that.
Yeah. I mean, this year. No, it started
Yesterday.
in December actually, on Goldman Sachs. I rolled it to December to January, January to February, February to March. Kept rolling it. And this is on a put spread, and it
For
just
me,
kept dropping like crazy.
yesterday, for me, it was yesterday.
What, Goldman?
No, SPX. When SPX started tanking, I had a 4110 put.
Huh. Right. So what's a credit spread? Very simple. You're opening up two options simultaneously, right? You're opening up a short contract and a long contract. So in the same type, they're either puts or they're calls. They have a different strike price and they expire on the same day. It's that simple. I put a screenshot of Tasty Trade, which is one of the brokers I like to use, of what a trade ticket looks like on this. This is a SPY, right? And it is an August 19th expiry, as you can see down here where I'm pointing with my little arrow. And it's a call credit spread, where I'm selling to open STO, the 45 call, buying to open the 430 call, right? So this 425 call is obviously worth more than the 430 call because it's closer to the money. And as a result of that, I'm receiving a credit of about $75 because I received $1.29 right here in credit, but I also had to pay for this 430 bought to open for 55. So it gives me a total credit of 75 bucks, right? And I like Tasty a lot for this. I mean, what do you get? Sonny, have you done any credit spreads yet?
I did one on Robinhood just to play around with it.
Uh-huh.
Just for like $20. Well, I got $20 from it.
Okay.
But I had a question on spreads. I'm a little confused on when you should wait for it to expire versus when you should just take profit. Because if you're getting the $75 credit right away, what's stopping someone from just closing that spread right there and just taking that $75?
You mean opening? You mean for me to open this trade at 75 bucks and close it right away at 75 bucks? Is that what you're saying?
Right, because the point of credits is as soon as you initiate the trade, that $75 is going to be in your account. It's going to be credited to your account.
Right.
I'm saying, when is it appropriate for someone to close the spread, and when is it appropriate for someone to let the spread expire worthless?
Okay.
Or let the options expire worthless, I should say.
We'll get into that. I'm not a fan of the options expiring worthless. I do it. And the reason for that is you want to make sure that you have no exposure for early assignment on it. So you want to make sure you're far enough out of the money, right, Arex, so that you don't have to worry about an early assignment on it.
Yep, literally me yesterday.
Yeah, because you can get assigned after hours.
Right.
So if you're close to the money, take that in the last half hour or whatever, but the trade is in your favor, I would pull the plug on it. All right, but we're going to get into what's the best exits, Sonny, okay, and how to get out of it, and different strategies to do that, because like in the case of Arax, he likes to hold to expiration and keep every last penny of that 75 bucks, right? And the classic trade I'm going to teach you today is going to talk about taking profits at 50% of the 75, or 21 days, whichever comes first, right? But you understand what the trade is, right? It's a short contract and a long contract opening up simultaneously, different strikes, same expiration date, and so that's what it is. Now, why do we trade them? Let's just take one side of the trade. Let's say call credit spreads. Call credit spreads are a bearish strategy where we are betting that the thing is going to go down. But even if it doesn't go down, even if it goes up just a little bit, we're fine, right? And as long as it stays under the short strike that we've opened, you're still going to be green on the trade, right? So we like the fact that it's a forgiving strategy. and it puts you in the position of being a seller of of an asset that's eroding in value. So it's kind of like, you sell your house for 500,000 today. Next week you go back and buy it for 400, buy it back for 400,000, and pocket the difference. Because you got a credit when you sold the house, and then you use that money to buy it back. But since the house has dropped in value by 100K, you only have to use 400,000 of the original 5 to do that. Higher probability of profit on the trade. We'll get into that. The difference in the probability of profit on a trade, as an example, would be, let's take Tesla here, and let's look at the trade. Okay, let's just say we want to buy a Tesla's trade at 850. Next Friday, we think it's going to go to 900. So we buy a 900 call, right? Cost you $1,400. Your probability of profit on that is 23%. Okay, and if you take a credit spread instead, let's say we decide that we think that Tesla is going to go down in price, or it's not going to go to 900. So instead of buying the 900, we sell the 900, and we buy the 910 for $225 in credit. Probability on profit of that is 23%. That's like 3.5 times what the probability on profit on a debit play is. Now, in return for that, you're limiting the amount of money you can make to $225, and your maximum loss is not the money that you paid for the $1,400 that you'd have paid to open up that, which, by the way, is quite a bit of money. Your maximum loss is $775 to make the $225. This $1,405 here, I mean, I don't know what it could go. There's really no limit to what it could go to. It depends on where Tesla goes to price-wise. But the probability of profit that we like to play is 60% or above, and try to keep at least, well, in this case, this is about 25% of the width of the width of the strikes. You get into 25% of it in credit. I think that's a pretty good play. I mean, ideally, you like to see 30, but if you can find those, please post them. 10 wide spreads for 30%. I can find them for you if you want to open up a 40 delta. All right. So anyway, we trade them because they have a high probability of profit, and you don't have to be entirely correct, right? Just be kind of correct. It's nice when if you can take a call credit, which is a bearish strategy, and the thing tanks, you can get out of it right away, find another trade. You may have to hold it longer if it just sits in one place, but as the clock ticks, it keeps going down in value. This is something that a lot of credit traders are constantly scanning the marketplace to try to find these plays. I have a tendency to have a bias towards to trade certain things that I know really well, but the mathematics on a credit spread work in such a way that if you do your research properly, right, you can find tickers that are just set up beautifully for a credit spread. And I'll give you an example by going here. Net, I found this one yesterday. Okay. So I think let's go on to daily or the 1 hour.
What a piece of shit.
This particular thing filled this gap to its main lows right there and turned right around. It got stuffed hard there. Went to this area of resistance, hit there. To me, that's an overbought position at resistance with a high RSI, and it's ready to. And so I think it's right for a call credit spread. All right. I don't know what the IV on it is, but we can look right now. IV's 46, which isn't bad in this market. I like to trade 50 or above, but 46 is pretty good. You have to remember the VIX has been just beaten like a dead horse, beaten to become a dead horse. The way it's playing right now. So that's reduced implied volatility and pricing of options throughout the entire market. I want that to come back, because once those premiums get up there, that's when you're able to make a lot more money, because the IV is elevated, right? So we're looking for overbought, oversold conditions, meaning overbought would be call credit spreads, oversold, call or put credit spreads, support or resistance. I mean, in range bound, which lends itself to a different credit strategy. We're not going to go through it today. It's my next class, and that's iron condors. And those, you can essentially almost double what you're getting in credits off of a put credit spread or a call credit spread by playing condors. But it's a more complicated strategy, a little bit more, requires more management. I know you run condors, ARACs, pretty often. I mean, how would you characterize the management of one of those?
It depends on when you time your entry to the call credit and the put credit. So it really depends on your timing.
But you open them simultaneously, right?
No way.
No? So you don't
Nope.
you don't sit in the middle?
Nope. If I see it run up, call credit, and then if I see it flush, I use a put credit for a hedge.
Okay. So you're using it more as a hedge versus a simultaneous trading strategy, is that correct?
Yeah, it's my way of staying delta neutral, I guess.
Right. But you're also using very short-term trades, right?
0 DTE.
Okay, yeah. See, in that case, I mean, it's the only way you can effectively manage it is by legging into the trade, because otherwise you could have it move against you, and you don't have enough time for it, to trade within the range. But if you take a look at what's a real range bound, what would be a really good example of range bound right now?
Apple.
Apple. So is this the daily? Let's go to 1 hour. Yeah, I guess you could say so. So 156. So if I'm playing a ticker like this, I'm looking to do call credit spreads at the top 10% range, right? Put credit spreads at the lower 10% range. Oh, I know the one that I had up the other day that I thought was ready to rock and roll for call credits, and that was Netflix. Not sure why what I had in here. It might have been on the daily. I felt that was just a prime candidate. Oh, I know. It got stuffed right there. Got stuffed right here after that gap. You got a huge amount of resistance up here. So if the market keeps trading sideways, this would be a good candidate for a call credit spread. So we look for support. We look for put spreads, resistance. We look for call spreads. Range bound, it's the top 10% of the range, and or lower 10% of the range, whether your bias is with a put credit or a call credit. Love to see IV elevated. I mean, you'll see that like going into earnings, although I'm not a fan of holding anything through earnings without understanding that your entire trade could go south because of that. But you'll find other times that IV is just elevated across the market, or in certain segments of the market, or in one individual ticker. And you can do that by looking at the IV rank. In the case of Tasty Trade, as an example, they have their own watch list, and you can use other screening tools and screening services. I mean, like for instance, NWS, it's got a 144.6 rank right now. I mean, that's high. That is really high, right? But I doubt there's any options to trade, and there's not. So even though the IV's rank is high, it's not tradable because there's nothing in the no volume, no open interest in the chain, which is one of the things you have to have. You want to have enough liquidity on volume on the contracts you're trading, as well as open interest. So, but this is what we use them: oversold, overbought, support, resistance, range bound, and when IV is elevated. Pretty simple credit spreads. Call credit spreads are a bear strategy. Put credit spreads are a bullish strategy. So if we're going to open up a call credit spread, our bias is that it goes down. Once again, you could trade sideways or even go up a little bit, as long as it stays outside your short strike, and you're going to be fine with it. Bullish is, of course, using a put credit spread. which is what I got blown up by in Goldman Sachs, why I had to roll it 3 months in a row. Okay, so let's talk quickly about the contract selection. This is the meat of the matter, right? I'm going to tell you about a strategy that I employ. It's your classic credit spread strategy. It's been used for decades by folks that trade these. And it all in the type of strategy that you want to deploy is going to be entirely based on the amount of risk you're willing to take. And secondly, the how much probability of profit you're trying to achieve. So the risk obviously being the amount that you're willing to lose on the trade, which, believe it or not, the more riskier, lower the probability of profit on a credit spread, the less you'll lose on it. And I'll get into that in a minute. So, contract selection, try to find an IB rank of at least 50. A lot of tickers are underneath that right now because the VIX is trading at such a low level. Okay, we want to open the spread. We want to find that underlying stock of at least 50. We want to open the spread 45 days away from the expiration. I'm suggesting that because of random market spikes and the gamma risk associated with what happens when you get close to expiration, and your delta starts going. The stock starts moving against you, and as a result, the delta is going up. And as you get closer and closer to the money, the gamma goes up alongside of it. And the gamma, of course, is the rate at which the delta increases. The delta increases. 50 delta increases $50 at each $1 move in the underlying. The gamma, depending on where that is in the chain, right, will give you the rate at which the delta is going to increase as it gets closer and closer to expiration, and as it gets closer and closer to being in the money. All right. This part, the whole idea of gamma risk and delta selection and theta, all the Greeks associated with this, I'm going to come back with this when we do the condors. And the reason I want to do that then is because there is a tremendous amount of depth to that. All right. And trying to put that in this class it would take way too long. Everybody would have their head spinning by the time we're done with it, including me. Okay, it's just too much stuff, too much material to cover in this in a one class that's trying to teach this strategy. So, 45 days out. That's what we're looking for, and we're doing that because to avoid random market spikes and gamma risk. I explained the gamma risk, but probably not as well as I should have. However, just understand that there is gamma risk closer and closer you get to expiration. Okay. We sell an out-of-the-money contract outside the expected move. We buy another out-of-the-money contract further outside the expected move. And just for purposes of an example here, I'm going to bring the Tasty back up and pick what you want to do, SPX?
Yeah, sure. Big though.
So let's go 45 days out, which I know you don't like, but...
Never mind. Go Tesla. Just scroll down so much.
Tesla?
Yeah.
Okay, so here's Tesla.
There we go.
Let's go September 16th, which is... it's not quite 45 days, but it's close, right?
We have September 23rd, 45 days.
All right, so here's... we'll just use this one. I'm using the monthlies because of liquidity. So we'll go September 16th. So when you go on the Tasty trade, what you're going to see is this bar, this brown bar. You can see where this comes up and down. That's the expected move. That is essentially how much the options have priced in where they think the underlying is going to trade within, the range is going to trade within during that period of time. You always want to pay really close attention to this expected move, but understand, as the price of the underlying changes, the expected move changes as well, right? So if Tesla jumped $50, this thing would move up probably to 70, at least 1,000. When you think ARX, $30, $35 maybe, $35, $40 on a $50 jump in the underlying for the expected move. That's what I'm thinking. I don't know if you agree. But so we want to make sure we understand what the expected move is there. We bought an out of the money contract. We're going to sell an out of the money contract that's outside that expected move. We're going to buy one that's outside that expected move, but it's going to be further outside the expected move. Now, for purposes of this class, and we'll get into this when we talk alternative strategies, I'm going to choose a 25 delta on the short and 15 on the long. And that's because I've given myself at 45 days out enough time for the trade to play out. I can make that delta width tighter, right, to reduce my risk. I can also go to lower deltas, which will increase my probability of profit, but also reduce the credit I'm going to get. Lastly, I can use width of strikes to determine what I want to play. So if I want to start with a 25 delta, I'll just find whatever the next 10 let's say if I want to play a $10 wide contract, whatever the one that falls 25 under, right? I'm looking for 70% pop, right, as a minimum. And the width of the strikes are going to determine the pop, and I'm going to show you guys that in a second. Pop is probability of profit. It also will tell you the amount of credit received and the buying power you're going to use to open the spread. Ideally, 1/5 to 1/3 of the width of the spread on the contract is what I want to receive in credit as a credit in my account when I open the contract. These are not that common, in my opinion, when I look through the market. Irax, you find them? You find them 1/3 anywhere?
Oh, very rarely.
Very rarely. So if anybody finds a 1/3, post it so everybody has the opportunity to jump on it, right? Because that, if you find a 1/3, that means that those premiums are elevated.
So condor.
So there's your checklist, okay? So let's go through the checklist and open and put a contract together on Tasty. On Tasty, okay? And let me put this over here. So I'm looking for an IV rank of at least 50, right? Look at the IV rank. Not exactly the best. I've seen it a lot higher though. But since Tesla is a pretty high priced product, you can get a pretty good credit on it. So I play it regularly, right? So we're just going to use this as an example, but ideally you like this IB rank to be 50 or above, right? So I'm going to open the spread 45 days out. This is on the second on our checklist. So I've got the September 16th, which isn't exactly 45 days out, but it's close enough. I'm going to sell an out-of-the-money contract and buy an out-of-the-money contract that's further outside the expected move than this one I'm selling. So let's start with the expected move and see what we can get for a delta. You're going to find this lines up pretty well all the time. Here's the top end of the expected move. So we're talking about opening up a call credit spread on Tesla. You can see where the 25 delta is. It's right here, 975. That's usually a spot you're going to find it, which is just outside the expected move, okay? And so what we're going to do is we're going to take that 25. Now, from here, and we'll just sell it to open. Right there, we put an order in to sell to open. Now, I can drop to a 15 delta, right, if I want to. And that takes me all the way down here and get a $960 credit, okay? That's one of the ways you can select it, is by going with a 25 to 15 delta, so 10 difference on the delta. All right, you got a probability of profit on this trade of almost 80%, it's 79%. Okay, and you give a probability of a 50%. There's a 50% probability you're going to get 80, that you're going to hit 87. There's an 87% probability that you're going to at least get 50% of this credit as a profit, right? And that tells you, and so that gives you sort of the probability of profits on the trade itself. Now, one of the key things is I'm going to roll over here. The max profit obviously is 960, and that's because when you opened it up, you got $960 credit on it, right? Now, here's the thing. The loss that you can take on the trade is equal to the width of the strikes, right, minus the credit you received. So the width of the strikes here are 25 plus 40, which is 65, right? Oh, so that's $6,500. That's the maximum loss you can take on this trade, is $6,500 to earn 960. And I mean, that's not the maximum loss. The spread is 65 wide, so 6,500 and you received a 960 credit. So you subtract the 960 credit from the 6,500, the width, and that gives you a maximum loss that you could take on this of $5,540 on this trade. That's the max loss, and that's how you always determine precisely what your maximum loss is going to be. Or if you don't want to do them, or if you want to screw around with the math, just come on here and click it. It'll tell you. So as you can see, that's a pretty big maximum loss you can take on that. But you got a pretty nice credit. You got a credit of almost $1,000, right? And you have a almost 80% chance that you're going to make money. That you're going to make money on the trade. However, you're going to find very few people will play spreads that wide, simply because you're using so much back, because you have so much maximum loss on one trade. Number one. Number two is you need to have this much collateral margin cash in your account, $5,540, which is the max loss you can take to open the trade. That's the amount of buying power you have to have, and once you use that buying power, it's wrapped up in this trade, right? It's your collateral against the trade that the broker keeps. So you have to keep in mind that as the wider and wider the spread, the bigger the buying power, the more buying power you're going to use, the larger the maximum loss, but of course the greater the greater credit you're going to get on it. You're going to find, interestingly enough, is there's not a huge difference as you get into lower max losses and using less buying power of the profit you can get on it. There's a difference, but you can see it's not a maximum difference. Okay, so that's the one way you can do it. Take a 25 and 15 delta, or you could take a 15 delta and a 5 delta if you wanted to, right? So you could take this down to a 5 delta. Where is that? Jeez, Tesla. And this down to a 15 delta. One more. And you have this trade, which gives you a credit of 780, probability of profit of 87, right? But the maximum loss you can take on this is 12,720 because of the difference in the width of the strike. So 1040 to 1175. That's a huge width in a spread. So I'm just trying to show you this by how wide you can do these things, and by going wide, how much risk there is involved. Okay, so one of the things that I like to do, one of my favorite things I like to do, is I like to use the width of the strikes versus the width of the deltas. So let's go to and I'll always usually start out at a 25 delta because it always ends up being right at the end of the expected move, at the top end of the expected move, or slightly out of it. So I would once again take this 25 delta, which gets me the 975 strike on taking the 975 strike on Tesla, which gives me a credit of gives me a credit of $2,040. But then instead of going down to the 15, I'll only go $10 wide. So I will buy the 985s, right? So now I'm $10 wide. So that means that the width of the width between the two strikes is $10. So my maximum loss on this is the width minus the credit I took in. So it's $1,000 because it's 10, right? $10 width, $1,000, and minus the 190 I received in credit. So now my maximum loss is $810. Probability of profit is 78%. And my buying power, same as a max loss, I'm going to chew up, is 810. Now, if you noticed that other trade I put up a few minutes ago that was a really wide delta, had a lot higher probability of profit, right? But you are also using a lot more buying power efficiency, and your maximum loss is a lot greater, okay? Now, you can make this even less risky by taking the strikes to 5. So now I've opened up a 975. I sold open a 975 strike on Tesla. For September 16th, and now I'm buying a 980 strike for Tesla for September 16th. Okay. Now, what has that done? It hasn't changed the probability of profit, right? That's still the same. What it has changed is it changed the credit I'm receiving down to $95. It also reduces my max potential for loss down to $405, which is the width of the strike, $500, 5 points, $5. It's 400. You have to use, the options math, which multiplies it times 100. Takes you to 500 minus the 95 you received in credit. and you got a $95, and you got a maximum loss of $405. Okay. Now, here's the one thing: is I'm always looking to get a credit equal to 1/5 to 1/3 the width of the spread in the contract, right? And those are really, the 1/3s are really hard to find. The 1/5s are a little bit easier. But if I can get $100, close to $100, which I don't know what the spread is on this. It doesn't say, does it?
5 width?
Huh? No, I mean
One-
usually there's a bid. I'm looking at. I'm wondering what the bid ask on it is on the trade. Usually they list that up here. No?
It only shows during the trading hour.
Oh, really? They only show the bid ask during trading hours?
Yeah, when you're trading, you'll actually see it going up and down. Up and down.
Yeah, like your natural market order is going to be still at 0.
I guess so. Yeah. So the reason the reason I'm saying that is I always throw it in there to get the most credit and see if I get filled, and then start eking my way back. And I don't know how to explain that when I don't have a bid or ask up here. But I guess it is what it is.
So do you put the price when you try to buy it? Do you put your price closer to the ask or closer to the bid?
I go to the bid. I mean, to the ask, which is the highest you can get.
Okay.
So let's say, for instance, and this is probably reasonable, actually. Let's say that the spread on this thing and the bid ask is at 90 right here on this end, and a
Dollar.
dollar right and a dollar right here. I'll move it over to 98 or something like that. Try to get filled. You know what? I might have. Hold on a second. Let me go back here. Did you guys understand that all the stuff I was talking about?
Yes.
Okay.
Yeah.
See, I must have took because I jumped all over on this stuff, so I'll make sure you understand it. There's a lot of stuff that you go through on that one slide. See, here's the same thing. I must have screenshot this after hours as well. Let's hope it, because there's no bid ask on it. Okay, so let's go back to Tasty. So what I like to use is the difference in strikes. I think the most people probably use this one. Arax, what's your opinion?
On what? For 10 width?
10 wide. What do you?
Oh
use?
yeah, I usually use 10 wides on anything triple digit or more.
Yeah.
If the share price is 2 digits, I use 5.
If it's a
So
two
what delta do you look for when you first get started? Though? I mean, are you looking for 25? Or are you looking for 15? Just even if you only get a $10 spread, are you looking for a 25 delta to start with? Or are you looking for 15 delta to start with?
On the short side, I'm looking for a 25 delta to start with.
Okay, so you're always going to be on the short side looking for a 25 delta. Okay.
That's where I start. Then
Yeah.
your intuition kind of kicks in. I don't know, blah blah blah. How, what kind of? I mean, I'm right outside. It wouldn't take much for that brown bar you see in the middle to climb right over the top of my 975. It wouldn't take much of a move on Tesla to make that happen, right?
Right.
So I could wake up tomorrow and this brown bar could be at 995, right? But
I've seen it.
right, yeah, of course you've seen it during the day. I've seen it happen during the day, right? So, but anyway, so you can.
You know what I meant, A-Rex?
Mm-hmm.
So you have this particular short strike. That's where I like to start. But you can change that depending upon how much risk you're willing to take. And of course, the less risk you take, the less credit you're taking. You're not going to change the maximum loss or the buying power use by moving the strikes farther out or even farther in, right? I mean, let's just do this once. Let's take the 40 delta right here on the short side. Was that you, Arax?
Yeah, I want to do that one day. That'd be nice.
Okay. So let's take a $10 wide spread there, all right? So now this is an interesting thing, right? This is way up inside the expected move. Now, why is this strategy used by some players? Well, because the maximum loss, right? The maximum loss has just changed, and the buying power efficiency has just changed. And you know why that is? Because you got a much bigger credit that's subtracted from the maximum loss. $10 wide, it's a $1,000 loss minus the credit you receive. So there are guys that are playing this strategy right here. They got a 65% pop, and all they're looking to do is win 2 out of every 3 trades.
and most of them are going to take it when it hits a 50% profit. So even though you said the probability is 68%, the actual 50% probability, 70, what is it? 76%? Is that what it says there?
65 on
P50?
this. 65 on this one.
How about the P50? What is that? That's
76%. There's a 76% probability you're going to get 50% profit on this trade.
so even taking. I think even Sonny was asking about that, or maybe I misunderstood. Is that you can get a 50% profit and just close it? I mean, let's be honest. I'm a scared trader, so I take my profits quick. So I'm probably the guy looking at the P50, and I made a big mistake when I played this. So I got to learn not to do what I did before.
Well, that's people.
Just like any other thing, you can lose. I mean, I think that's one thing. That's a lesson I had to learn. So.
Right, but I think that folks here that have not used this strategy prior, I think you can. I don't. Fidelity doesn't allow this, but there's got to be places out there you can paper trade it, right? Actually, watch the trade unfold. It's not going to teach you how to trade it, but it's going to give you an understanding of how the price moves based upon what the underline's doing and how it affects the contract. So you can watch that by actually having a trade in front of you where you can see it. I mean, the only way I've ever learned how to trade anything effectively was when I had money on the line.
Well, that's me. I'm an OJT guy. I got to have money on the line to make it worth my while to take the risk.
Yeah. I mean, I got bored on a trade today that I did have money on the line, and here I'll show it to you really quickly. And I'm still irritated about it, which is why because I always love showing stuff I'm irritated about. I'm sitting right here. I'm sitting right here with a put, and I got bored with it. I closed it.
Well, I got out early. I played the same one. Remember, I jumped in and I said, okay.
This was.
You said you closed it early.
This was a several $1,000 trade just by staying in the trade another 5 or 6 minutes.
Oh, when he did the Tesla, yeah.
Right there. Oh, look at and I'm still trying to find why the hell this thing went from 856 to 840, and these are 1 minute candles here. Okay, 1 minute candles. So that's like what, 15 minutes? Not even. 1, 2, 3, 4, 5. Yeah, about 15 minutes. I looked at the news. I have no idea why this thing got flushed like that right there. But anyway, I'm sitting up here because it just seemed like it was toppy, right? And I wasn't committed to it, and so I just got bored and I got out. So you have to having money on the line will make you more committed, but you have to be committed to any trade to understand how it's going to play out, right? Because the purpose is you want to learn how to do something so you can repeat the process over and over in such a way that statistically you're going to profit from the strategy, right? And if you do repeat the process that I'm showing you here over and over and over again, you will profit from this, right? I guarantee it. You will profit from this strategy. But you have to be able to manage you have to manage the trade in a way that you're comfortable with, because I can't tell you what that is, all right? I mean, I can tell you to take, I can give you trades that I think you're going to get really comfortable with. I mean, I'll give you an example. Just as an example to practice, Sonny, you still on here? Yeah, just as an example to practice. Let's go out to August 19th on the SPY. All right, that's what, 2 weeks away, or is that next week? That's next Friday, isn't it?
Yeah.
Is that next Friday? Yeah.
Yeah.
So let's go out here, all right? You think this thing's going to 440 by next Friday?
Depends on CPI.
Yeah. If you asked, what's that guy's name, John Lee or something like that, he thinks so.
Thomas Lee.
Lee of Fundstrat.
Yeah, he's crazy.
Okay.
He disappeared for a while earlier during this whole
After February.
Now all of a sudden he's back, So anyway, you take this trade right here. I don't even know, the commissions might cost you more than the credit, but you take this trade right here, and you get $1, right?
That's commission already.
$1. 98, that's your commission already, right? It costs like 65 cents, I think, for a contract or something.
Yeah, and then so 2 times, so it's $100.30.
$100.30, you got to get $1.30. So you're not going to make money on this trade. So I lied. So let me move this out to 442. Well, you still want to get $1. Let's move to 438. Oh, there we go. There we go. 438.
The deltas are too low.
So you get $4 on this trade. Your
delta.
Your probability of profiting on this is 97%. Your probability of getting at least 50% of that, of getting $2 off this trade, so at least you pay for the commission, and you got 75 cents left over for I don't know, what do you buy for 75 cents? Your probability of
No.
profit is 97%. So my point in saying this is I'm cartooning this because you can make these trades as close to risk-free as possible. But if you're going to trade something on a regular basis, especially call credit spreads, you can actually produce very, very good income on an annual basis by playing these trades without without spending all day staring at the screen, right? So let's go. Let's finish this particular slide here really quickly. So we were looking for an IV rank of 50. A lot of them are not there right now. We need the VIX to help us out on that one. We're looking 45 days away. We're selling out of the money, buying out of the money. Out of the money, we're selling is closer to the strike price than the strike. The strike price of the out of the money contract we're selling is closer to the price of the underlying than the one we're buying. Okay, 25 delta on the short, 15 delta on the long. You can see the credit you get on those is going to be very, very high as compared to just using a $10 spread. But you can decide to play it that way. Those are two different strategies I see people play all the time. Looking for a 70% pop, that's the full pop and a minimum. And the width of the strikes you choose will determine the pop. And you can see that, not only just the width of the strikes, but also how far you are outside the expected move, right? You can see that by taking a look at this right here. You're so far outside the expected move. What's the expected move is 420. That would be a hell of a move to 440 by next week, wouldn't it? Jeez. So by being this far out of the expected move, you increase your probability of profits to a substantial amount, right? I'm looking to get a credit equal to 1/5 to 1/3 of the width. Well, that didn't happen here, did it? And the reason for that is because you didn't play close enough to the expected move. So I covered a lot here. The IV rank, we went over that. The spread, 45 days. Selling and out of the money, buying and out of the money. Out of the money you're selling is closer to the price of the underlying. You can use a 25 delta and a 15 delta spread, or you can use a $10 spread or a $5 spread, right? I think you were mentioning to me, where did you stick with $5 ARX? That was when you went to a two-digit,
On SPY, because it doesn't move that much, it's like $5 moves are like really big. So for SPY, it's $5. But for like normal ticks, anything 2 digits, I do $5 spreads.
So like this right here, like for instance, this is.
Oh yeah, definitely $5.
TTD. All right, so this ran up off of earnings, so it might be primed for a credit spread. I don't know if these things are going to be worth a lot more tomorrow because I think it's trading at in the mid 60s right now. But here, using you sell the 70. Buy the 75, you get a $22 credit on this. This will not hold true tomorrow when it opens because it had earnings and it crushed it. But your pop is 72 on this. Probability of getting 50% of that $22 is 80%. And of course, since it's a $5 spread, it's $500 minus the credit you received. Maximum loss 478. Maximum loss is always equal to the buying power that you need to have in your account and is used in your account to execute the trade, to open the trade. Okay.
This might be a silly question, but you could open up multiple of these, right? So if I wanted to open up 10 credit spreads, is that something that's normal or?
I open up 20.
Oh, okay.
If I was playing this one right here, I'd be looking for at least 10.
Okay.
I'd be looking for at least 10 because it's just not worth it otherwise.
It's still not worth it. For next week's? Are you kidding me?
Yeah. So, we're just giving examples and we're going to go into strategies a little bit deeper in a minute. But once you start playing these, Sonny, you're going to start seeing, okay, because you have to remember that the width of your strikes, just using that as an example, using that as a strategy is to keep it to the width of the strikes. You got to start taking a look very closely at what's the credit I'm getting versus, like right now, I just jumped that to 6 of them, right, didn't I? So let me go back to 1. What's the credit I'm getting? $22 against a buying power efficiency use of 478. I can find stuff out there for $100 that I can use that I can get that use that buying power efficiency and have that as my maximum loss of 478 and get $100 off of it. So that's what you want. You want to try to get. That's why I'm saying when you're pricing something like this, 1/4 to 1/3 of the price of the 1/4 to 1/3 of the width of the strikes. You want to get that as your credit, right? So if it's if it's a 10 strike, 333 would be. I mean, tell me when you see one of those that you're outside the expected move, because I'll jump all over that, right? But getting $300 on a 10 wide spread is a massive win, right? So, I mean, when was the last time you got one of those ARACs?
Wow, I have no idea.
1/3?
Amazon?
You've gotten 1/4, or you've gotten 1/4 already, haven't you?
Oh my god. But I was on SQQQ on a downtrend and it was really close into the money.
Oh, they closed in the money?
No, it was like super close into the money. It was like in the expected move.
Oh, you opened up inside the expected move.
Yeah, it was like a 30 delta.
Yeah. Okay. Well, so you can get. I mean, there's an argument to be made, and I'm going to go into that on the next slide. So, is there any questions right now before I go to the next one, Jeff?
If you did the SPX and you sold the 4230 for the 19th and bought the 4250, I mean that's 370 right there, and it's, I mean you got to have 1630
August
available,
9th, August 19th.
August 19th. That's a 78%, and
What's
P50 is
what's the
85%.
contract? What's the contract?
Sell the 4230.
It's a 20. It's a 20 delta. Okay.
Oh,
Um,
I
which
this
one?
is
How
why I
far?
lost
What's your
money.
spread going? 10? You going 10?
No, I went 20. I went 4250.
Okay. So, you know, you're obviously taking on, you know, that extra $1,000 of risk, right? By doing that. So you got 1630. I don't know what that comes out to percentage wise. 370 of 20. That's still only like less than 20%, right? So like 18% or something, right?
yep.
Did I
Yeah.
get that right? About 18%.
Yeah.
So I'm not sure I'd take that kind of risk, 370 against 1630. You know, I'd be looking for,
It's about 22.5%, almost 23%.
was it 23%? Did you did the calculator?
Yeah.
I was just doing it in my head.
I'm sitting behind a computer, so.
Oh, okay. I'm just doing it in my head because I don't have my calculator sitting in front of me. So, I mean, listen, there's ways you can make an argument, Jeff, and ARACs. You can make an argument here that this trade right here, right, has 78% probability, right, and 80% probability of profit of 50, and a $2 credit against a max loss of 800. You can make the argument that this is the same trade. You've lowered your probability of profit 3% of the 50%. But now you're taking in $250 in credit, and you've dropped your max loss to 750, right? And that's just playing a 25 delta, all right? You could also make the argument that, let's see what it does to the probability of profit if I jump it down to 4,200 and 4,210. Because the max loss is still the same, right? 710. But my probability of profit is 72%. My probability of profit is at 75% of getting 50% of this. Now you're up. You could probably end up getting this for 300, I bet you, if you just sat on the bid, right? Now, you are inside the expected move, so you could get run over on this. However, you've reduced your maximum loss because you got a bigger credit. And the closer and closer you get in, like I said, there's a lot of guys that play the 40s. So you go 4160, 4170. Now you're at a 62% probability of profit. I forgot what the last one was. Wasn't it about the same here? The probability of profit at 50, mid 60s? Wasn't it?
That was in the 70s, I think. It's 72 and 75.
The last two I put up?
Yeah.
Okay.
The 4210, 4200.
But now you're taking in close to half of the credit, right? $430.
That's
So
a 41%, almost at the 4200 and 4210.
what's
But
it-
I mean, for you to get the 41 cent, you got to remember the SPX moves what $40-$50 in a day,
correct.
and can move higher.
Yeah.
That's the only thing that scares me about that is that.
Oh, you can. Yeah, we'll get into exits on this because this, you know, your probability. Here's the thing you're looking at. Instead of losing, you know, a lot of the trades that we take are that we end up getting. And it seems like it's a lot. And you tell me if this is your experience, ARX. Is this 880 to 900 max loss? Does that sound about right?
Yeah.
Okay, where you're getting 100 or maybe 120 credit on the trade. So you need to you can be wrong. You're wrong once on one of those, or you're wrong a couple, three times on one of those, and you get run over. That's a substantial amount of money that adds up. Here,
Yeah.
you could here with this trade right here. I understand you can stop. Like for instance, the guy that one of the hedge fund guys that uses this strategy, his stop is 2x the credit. So he'd stop out at $860, basically taking a full $130 loss, not the full 570, right? That
So
makes
he's
sense?
saying if it goes down to 430, I'm out. So if it
He
goes where
works
I'm
the
down,
math. He works the math where if he's winning 2 out of every 3 of these trades, right? And
Right.
he's taking his stop, and the other one is getting stopped out, not losing the max, but getting stopped out at, comes out to about a 56% probability, 56% win ratio he needs to be profitable. And if you get into the 60s, it becomes very profitable. Does that make sense?
Oh yeah.
yeah,
Right? Because you're not risking as much here. Now the trade needs to be managed, right? I mean, you may have to roll it, and that's why, here's the thing about this, especially when you look at where the SPX or the SPY is traded. If you can, you're talking about sitting here maybe with a drawdown for 4 or 5 days, and then 4 or 5 days later, it goes the other way on you. I mean, the market's not going to go straight up. That's the whole purpose of this, is you're trying to trade something that is going to move within inside of a range. As long as you don't let it get to the point where it's gotten down to your long contract, that's where you can't fix it anymore. It's really, really hard. Then all you can do is just cross your fingers. And I had one of those last year, Etsy. I got
I
it.
had that with Tesla.
Yeah, and you closed it, right, Jeff?
I closed it, so okay. So I'm going to say something, and it might come out wrong. So I lost money on that trade.
Yeah.
And the reason I say I lost money is because my buying power went down, because I had to take a loss, and I took I tried to buy. I did the stupidest thing you could do. I tried to average it down, which was a huge mistake. So all I did was double my loss. So that was the biggest mistake I made. So I actually, to be honest with you guys, I did this like 6 times before I lost one. But that one loss kind of beat me in the head. But 6 times I wanted this, and 1 time I lost. But the loss was stupidity. But that's how you learn. So I'm actually going to I'm going to do it again. I would just say I'm building back up that account, because I'm sitting here going, okay, I've been scalping, and after I took that beating, you sometimes have to reassure yourself that you can do this. So I like that. I like that trade better, because I agree with you. I think for $510 loss to make 530, because I'm looking at this one right here saying the 4,200, 4,210, that's 290, but I got to risk like what, $1,200 or something like that, $710. But that's a 40% profit, whereas 430 to 510 that's a huge profit.
Yeah, I mean, if you can get this is a credit that is more than 40%, right? It's
That's
a
almost 100%, dude. I mean, you're at 430 to 510.
No, but I'm saying
So if
40% of the width.
Oh
The
yeah,
width is 10. You're at 43% of the width.
yeah.
Oh,
Right.
that's so bad.
So the argument to be made for this trade is that if the credit, if the spread moves against you to 860, you close it and you take a $430 loss.
Yeah.
Okay. Or if you want, sit back and twiddle your thumbs. That's what I did with Etsy. I let it run. Shit, I ran 10 under my long, and came back and closed just a couple bucks above my short on day of expiration. So, and I think I had a bunch of people in that trade with me that I haven't seen since. So, so anyway, this is a different way of looking at it than what we have traditionally. Traditionally, I would look at maybe doing. I don't want that one. Let me see where the 25 struck. 25. Okay, so the 25 delta here is inside the move. So I would probably drop down to the 19 delta. Sell this one. Buy this one. It's $200. So I'm I'm risking a possible loss of $800 to make 200. So
So what you're saying is your buddy would do a 2x. So he would say, if this thing goes to 400, I'm going to stop out.
correct,
Okay.
correct. So he loses $400 on the trade versus the max loss of $800. Okay.
Understood. Okay. Makes sense.
Now his stop loss on these ones where he gets more credit is he's losing more on the stop loss trades, but he's also one of these guys who he plays SPY and SPX a lot, and just sort of has this whole reversion to the mean view of the market, right? So like right now he considers the market overbought. Now it doesn't mean he can't get more overbought, but he thinks call credit spreads are definitely the way to play the market right now. That it's run so hard and so fast during the course of this. When did this thing start? Where's the? Let's put the SPX up here.
A
It's
month
in
ago?
middle of June or whatever. It's the daily. I mean, there's a couple different things here about this. Okay, so here's June 17th. That's the low of the year, right? Isn't it?
Yeah.
30,
No,
huh?
I
36,
don't know. I don't have the year.
36.33.
Yeah, that was like in June, mid-June.
Yeah, right there, 36.33. So he thinks, and he thinks that this thing getting stuffed here, and getting stuffed here again, is
So he
indicative.
thinks it's going to come back down.
Yeah, he thinks it's going to trade in this range. He thinks it's got stuffed here over a period of an entire 5 trading days. It tried to break through there and never got there, and he's comparing that to where it popped off of that over and over and over again as support during a 5 trading day or 6 trading day period. Then finally broke that support, and then now that's a strong resistance area. That's why I have those red lines there. Moved through it just a little bit yesterday, but then came back hard. So that's his opinion. Plus, he thinks he just believes that there's, no matter what happens going forward for the rest of the year, that there's just not enough bullish sentiment for the fuel and engine to go like where we had it beforehand, where it just ran right up on us, right? He just doesn't think that that's there. Now he could be wrong. I mean, he's guessing like all of us are, but right now he's looking at this whole area. I know he's put call credit spreads on through all of these trading days right through here. So
Can I ask ARAX a question?
What's up?
So I know this, I'm sorry, I'm probably digressing here, so I apologize, but when do you stop out? I mean, because we were in the same trade, and obviously you moved from a put credit to a call credit, and you made money on it, and I was sat there and went, holy crap. And the problem I had, just so you guys know, is I had a 3-day trade counter with Tastyworks, so I could not sell. If I sold, I would have hit my 3 days.
Right.
So I said, okay, well, I don't want to get punished for 90 days. So I said, I'll just let it flow through. So when you do this, where do you stop out? I mean, do you give it a 10%? Do you do a 20%? Or
On 45 days, if I lose twice the credit I'm gonna get, I stop out. On a 5-day 5 DTE, I
10%, 20%.
the whole credit. I get out.
Okay, you take when it gets to that credit you're taking. That's your loss, stop loss.
Yeah. On a 0 DTE, if it breaks 2 important levels, I am out.
And you can play it. I mean, I think the closer you get to expiration, the more you have to use your technical skills to know where what the underlying is doing. The whole concept behind a 45-day to expiration contract is market's going to do what it's going to do, but over a course of 45 days, it's going to do it a whole bunch of different times, a whole bunch of different ways. And as long as it keeps gyrating like that, the clock is ticking, these things just continue to lose in value. And the reason we don't go inside 21 days is because there's a gamma risk there, which I tried to explain earlier, but it's going to take longer to explain that. Just take a look and you can see on the chain where gamma is at its highest, which is right at the money. So we don't want something. Go ahead.
sorry, can you mention about I know how theta works, but when you're doing a short analog, do you just subtract the theta? So if one theta is like 0.75, and that's on the short side, and if the theta on the long side is like 0.10, do you just subtract it out? How do you do that?
To determine what?
So I'm just trying to determine because the biggest advantage to doing a credit spread is theta kills it, right?
Right.
Right. However, you don't really care about the long. The long is your hedge. You care more about the short strike.
Right.
So you care more about that theta instead.
Okay.
So you're talking about you want to try to get as much theta as possible. Is that what you're saying?
Yeah.
Okay. Well, I mean, the way to get as much theta as possible is go right at the
Zero.
money.
Right at the money, 0 DDE. There
Right.
you go.
There it is, right there. You
That's max theta.
Okay, there's max theta right there, and there's your $540 against a $460 loss if you want to be directional on the trade.
Wow. Okay.
So now you're actually your profit here is greater than your maximum loss. Your potential profit is greater than your maximum loss. You're
Does
probably
anybody do that? Oh, but you're playing right at the money, so that's not a good strategy.
Depends.
I'm sure there are people who do that. If you have a really strong directional bias and you're right, I mean, it's easy money because as soon as this thing starts peeling back, especially if you're doing it on the weeklies, as soon as
Yep.
this thing starts peeling back, this damn thing's going to lose half its value.
Like, for instance, yesterday, SPX 4180 right at the open would have been perfect because it just collapsed the entire day.
Yeah. So
Oh,
I'm sure there are people.
So do you play though? Do you play that ARX? Have you
I
done
played-
that, Richard?
Have I played at the money? Yes.
come on.
But I mean, it's not something I'm teaching here, nor is it something I'm recommending. But I have a really, a very, very strong directional bias, and the amount of time that till expiry is going to be pretty contracted compared to a classic credit spread, right? I'm looking to do this because I think that something like Tesla's run to, one of its big, like prior to the morning, pre-market morning, after Tesla announced that, announced that split was, the vote was approved, right? Approved split. The next
Right.
morning, I knew, I didn't know, but I was very strongly biased towards the fact that thing hadn't moved. It was still trading at what, 927 or something. It's like it was closed at 925. It's moved $2 on that. This thing's going to go down. They're going to sell this news, right? And it did tank. So I wouldn't have a problem with that. With that, understanding that, I might take a stop loss. I might take a stop loss here of maybe 200. Maybe half of the max loss that I can take on it, something like that. But that's more of a directional trade. So now you start to get into the whole concept of, man, am I better off trying to find a $460 put or $460 naked call, naked put, and just play that, understanding I can lose the $460 on that. Plus, I can easily stop out on that for probably a lot less if I want, right? So then, when you're playing at the money, you can get in the argument of, do you want to screw around with call credits that use all this buying power? Well, in this case, it doesn't, only $460. Or do you want to just go, when you have a strong directional bias, just stick with debits because, they're maybe a little bit easier to manage, right? It depends, but I like to sort of have a portfolio of call credits out there that I'm looking at every week and going, okay, I'm going to roll this one. I'm going to close this one. It's at 50%. I'm going to open up another one on the same ticker and just keep playing it over and over and over again. Always having one open on a particular ticker that I'd like to play call credit spreads on, and having one open on, and when I say one, I mean one position. Might be 10 contracts. I think you did 100 contracts, didn't you, Irex?
Spread out though.
Huh?
Like they'll spread out like week by week though.
Yeah. So you spread them out,
Like-
sort of like the they come due like tranches.
Tranches, yeah, like 10 here, 10 here, 10 here.
Right. So anyway, ENPF. Does that answer your question, Jeff? Jeff,
Yes.
Yes.
okay, 8. What are we going to do here? We're selling the
EMP.
340 going 20 wide, huh? Which date? To September 16th?
What the?
All right, 340. He's going to gamble. He's outside the expected move. 30 IV 30.
Oh,
You want to go 360?
okay. What's the directions? What is
Okay.
the direction?
What do I think of getting $288 on a 20 wide spread? It expires in 45
Wide.
days. I say
September.
they're not. I think the contracts are underpriced for my liking.
I think it. I think
Huh?
uh,
Would you agree, Rex? 20 right.
288 for 30. Oh my. For
45
20?
day, for 45 days and a 20 spread.
Oh God, no! Disgusting.
Yeah. So, I mean, I'd be looking on a 20 spread. I'd want to get 350 maybe, 375. Even that's
Around there, yeah.
Yeah.
For 39 days, definitely.
Yeah, for that far out. So, and you know, there's no formula for this either. I know, like Jeff and 8 and Sonny. There is a formula. We're looking for a percentage. 1/5 would be the, which is 20% of the width, would be, so that would be $200 on a 10 spread, $400 on a 20 spread, right? So 350, 375 is even underneath what I'd like to see. So just think about it in terms of that. Take take 1/4 of the width and kind of use that as your guideline. If you can't get that, move on. There's a lot of shit to trade.
Okay, got it.
Also, time cost too. Like you really want to wait 39 days to make that little money.
Right. All right, so let me move on to the next one. Alternative strategies. Well, we're already talking about that. Same week expiration, quicker turnover. You can use lower delta values to take the gamma risk out of there because it's going to be too far away from the money where the gamma's not going to come into play. And if it does, it's far enough out of the money that even a 1 day spike shouldn't hurt you. 1 day spike or drop. What's your delta on a zero day to expiration?
5 or less.
Okay, 5 on the short
And-
side.
And I had a 5 delta turn ITM before.
When?
God, what was it when SPX just charged way up
Recently?
past 40-50? Yeah,
Recently?
I think it was last week when SPX went above 40-50. Oh, that was terrifying.
On SPX. Here's SPX last week.
Yeah.
Where you said 40, 50?
I think it was 40-50.
No, it's April.
Like,
I'm in April there. What am I looking at? I'm looking at the wrong thing. Last week
yeah,
here?
last week.
No, that's June.
That big
Yeah.
spike.
Here? Here?
Was it July?
No, this is last week right here, I think. No, it's today. This is today.
No, not today. No, today I was fine. When
So,
was it?
I don't know. Well, anyway, that's unusual for a 5 to move in the money. I mean, there's a 5% probability that would get in the money. So, that would be an outsized move, to say the least. So,
Very upsized.
15 to 20% stop losses on the 0 days or the weeklies is what I suggest. All right. And you got to remember, there's always an early assignment risk when you're trading same week or same day spreads if you're close to the money, right? So you just need to be aware of that. You don't want to ever. You don't. What's that?
How stringent is that? For example, is there also a risk if I'm trading next week expiry, or is it mainly same week, same day spreads?
Early assignment for the next Friday would be really unusual because there's still that much time value left on it. Thursday or Friday, it can happen. I mean, it's always a very low probability of getting an early assignment risk, right? And if it's not in the money, it's really close to zero that could happen. I've never
And that
I've
just
never
means
been
where you
assigned.
have to.
Has anybody here ever been early assigned on an option? I never have.
No, always after.
No.
I've never been early assigned on an option. So,
And that just means that you're then forced to buy the underlying stock for 100 shares, right?
right,
For 100 shares of the underlying stock.
right at the price that
Okay.
you open the strike at, the strike price. So we talked here about the alternative 50 delta on the short, but you want to get that 1/4 or maybe even 1/2, right? I mean, you want to get one, you want to get 1/4 is 25%. If I'm looking at a 50 delta, this is a typo. This was not meant to be 1/4. Okay, this was meant to be 40% of the width of the strikes as opposed to 25. I typed that wrong. So, I can.
You know, it was last Thursday. That's
Geez, 40%. Change that on here so that when it gets into the. There we go. Did it change on here? Yeah. Okay. Just 40%. Credit on the trade. Okay. I want somebody to think that you're going to do a delta of 50 and only get 1/4. So what this does, of course, is it puts you inside. You're going to be inside the expected move at 50 delta. You're going to be almost at the money, right? And so it's going to reduce your probability of profit, but it's going to increase the credit you received by a lot. All right. So that means that, and we just went through this, it reduces the amount of the maximum loss that you can take on the trade, and the amount of buying power that's used to open the spread. So once again, let me just throw Tasty up here. Let's clear this. Let's go Tesla again, because we all know that one. I love it. We love it and hate it. Oh, just go ahead and signed out here. Love it and hate Tesla, right? Okay, another reason to hate it today. September 16th. So today I closed at 8, right around here, right about 850. So your 50 deltas are down right underneath there. So you wouldn't play that. Wouldn't play that unless you're willing to take the risk associated with playing something that is that close to the money. All right. So if you drop down to the 40s, let's take the 39. You're in a little better shape at 910. Although it's not, you're still well inside the expected move. You're halfway between the current price and the top end of the expected move. But once again, if you're playing a 10 spot, 10 wide, right, 9 and 920, you're playing a 10 wide. Your buying power and your max loss is down to 665 area versus it would be, closer to 880, 890 if you moved up outside the expected move. So when we talk about this, if you're going to go with a higher delta, make damn well sure you get at least 40%. Like this one here isn't even paying me 40. All right, and I'm at a 40 delta, 39 delta. So I probably have to go to 900 to 910. Still doesn't give me 40. Probably wouldn't take the trade. I'd want to get the buying power efficiency and max loss down maybe to 600, and then it would be really interesting. Although you're at 33%. It's still, you can find trades like this out there that you can get 40% at by going with a 42 delta or 41 or 40 delta. All right. It also, once again, this trade requires more defined directional bias in the underlying, which means you need to have a stop loss. 2x credit received is what I like to use. You can use less than that if you're. All depends upon how you like to trade. So, expected move. Does anybody have any questions about this? I use Tasty. What do you guys use?
EOS.
TOS. And it has a. How does it show the expected move? Just by a number?
I don't. I caveman use deltas.
Huh? Use deltas?
Yep.
All you have to do is add at the money, and at the money, call and put too, right?
I just use the deltas as a probability ITM.
See, I think because it's 850 to 970, right? So 120, right? Excuse me, 850. So it's 120 expected move by adding these two together. The 850 call, the 850 put. That gives you the expected move too. But and you can see it adds up here to not to 970 and change.
That's how they do it.
But that's the math behind it, is just adding the at the money put, at the money call. Well, and it's not exact because it's not at they're not precisely at the money. It's stocks trading 851, 849, whatever.
That's what I'm using also.
Yeah, used it to add them up like that.
Yeah.
Okay. So
It's,
big.
and you can use a formula. You can do like times 85% or 90% or something.
Okay. So expected move. I mean, I would suggest that everybody start out understanding how to trade these and what happens outside the expected move. Because this expected move, again, I'll reiterate, this thing moves when the stock moves. When the stock moves down, this buyer moves down. Stock moves up, buyer moves up. And it's just all based upon what the at-the-money prices for the options are added together. So whatever, if this moved to 900 tomorrow, whatever the at-the-money price of the options would be added to the upside of this, right? So whatever that adds up to is where the expected move would be. So you got to monitor this. It's not unusual to be in a credit spread trade and get inside the expected move, especially if you're playing like 25 deltas. I mean, you're only $5 outside the expected move. Tesla can do that during the course of an hour or 15 minutes, actually. So it's a personal choice as what strategy you prefer. I'm going to suggest everybody here that's starting out play outside the expected move, or play substantially outside the expected move. You could still make money doing that, right? Let's go back to Tesla again. Clear it. Here let's say we go to September. You got plenty of time to let the thing play out. You sell the 1,000s, buy the 10/10s. You got $150, and well, see here they're showing the bid asking here now. See that?
Mhm.
See that there? On the bottom?
Yep.
Well,
That's it.
it wasn't saying it
115
didn't have that before, did it?
Nope.
No.
That's a wide spread, huh? The point of now I can make this point, and maybe even can I move this? No, it probably won't let me. Will it? Let me see. Sure. There you go. Okay, I can move this to somewhere between halfway between the mid, which is 171, or I mean the mid, which is 148, and the top end of the spread, which is 180. Get it all the way up here, and see if I can get a fill at 171. Okay. Or if you want to get more, if you really want to get in the trade badly, you move it closer. Farther away, the longer you may have to wait. But it's also a way to manage your risk a little bit in terms of thinking, okay, this thing still may pop up a little bit on me if it's a call credit spread, or drop a little bit more on me if it's a put credit spread, right? To try to get as close to this maximum credit you can get on it. And if you don't think that makes a difference in your percentage over a whole series of a lot of trades over the course of 12 months of trading, look at the difference between 148 and 180. You're not going to get the 180, but it's quite possible you could catch a spike on it on a call credit and potentially get 170 on it, right? 168. So going far outside the expected move, you can keep rinsing and repeating these trades all the time, and just wait for and play the highly volatile stocks. And wait for that 1 day or 2 day or 3 day run, or it goes in your favor, and pull the 50% out. Without, in some cases, on the very same day. Right. All right. We're getting really long in the tooth on this, so let me go through this. You guys, this is going to be recorded and in the class with all these notes in the podcast. So, maximum profit. Well, you already know what that is, right? Whatever you go open a credit spread for. You open it for $50, you get $50. It's so much as you can make. Case closed. Maximum loss. Maximum loss is put right there in tasty. But in essence, what it is, it's the difference between the strike prices plus whatever the credit received when you opened it up. So if your max loss is $1,000 because it's a 10 wide spread, you subtract the credit you got on it of, let's say, a $200 credit. Your maximum loss is $800 on a trade. Break even is calculated by just adding the credit received to the short side of the spread. So if you received a $50 credit on a 10 wide spread, short strike being 90, your break even is 90.50. In other words, the stock can go all the way to 90.50, and this is at expiration. The stock can go all the way to 90.50, and you still break even on the trade. Questions on that?
No.
Good. 21 days to expiration or 50% plus profit. That is the that's the gold standard in my opinion on how to trade these over and over again because of your elimination of the random spike in the market over a period of 4, 5, 6 days is taken out of it because it's got plenty of time for it to work. If the trade moves against you, you can stop out in the trade. If the spread is increased in value to twice the maximum profit achievable or twice the credit received. Or you can roll it out. All right. If you end up buying Etsy before earnings and you're hitting your max loss the next morning before the market opens, you can sit around like I did and wait, which is what I did. And I ended up keeping the whole credit right down to the last day of expiration. Obviously, you don't want to get there if you don't have to, which is why I never recommend playing through earnings. I did that time. Some people followed me. Bad choice on my part. And I wasn't drinking that day. So, rolling the spread. Jeff, you didn't quite understand this, did you?
I am lost as a puppy in the woods, man.
You what?
I'm as lost as a puppy in the woods.
Still, right now?
I know, I know everything here. The only part that really gets me is the rolling. Now I understand it. I do understand the rolling, how it works is that you still have to have enough buying power to roll it out. If you don't have enough buying power, you're SOL. You just can't do it. That's the problem I ran into. Because I started with so much capital, and then when I lost that money and then I tried to roll it, I didn't have enough buying power to.
Okay. So you're telling me that you had to buy this thing back at like $600 or whatever, but you only had you only had 500 or 600 in the account.
No, I started with 1,000 in the account.
Okay.
So, and I lost $600. It's funny you should mention that because I lost $600 and dropped my account down to $400. And then when I tried to look for another spread, I couldn't find anything for the $400. So I was like, at that point you're SOL and saying, well, I should have started with more money. But I didn't want to start with more money. I wanted to learn the process. So
I got you.
You know.
Well, when you told me, now I understand something that I didn't understand back then. I'm thinking, what's he talking about? Just roll it over. Close. I mean, because you're going to get that same amount of money back. But yes, you need to have the capital in place to execute the trade, is what you're saying, right?
Yeah, and if you don't have enough buying power, you can't do it.
Right. I mean, if you had enough buying power, you could have put yourself back in the same position you were before in terms of the amount of credit in your account, right?
Yes.
Okay. So, if the trade moves against you, right, you can close this spread and put it and open a new spread further out in time, and maybe even further strike prices, further out on the strike prices. Okay. The key to this is if you let that spread go in the money, meaning get under the long or above the long, depending upon which direction you're playing, your long contract now has more extrinsic value than your short contract. So a roll here is almost impossible to find a credit on it. Now you can roll it for a very small debit and reduce the amount of loss you're going to take on the trade as a whole, but you just don't want to ever let it get there, right? So the only reason that should ever happen is because of some event that overnight throws the helter-skelter thing on the underlying and causes it to get in the money. But you want to try to avoid that, right? The best time to roll it is when the spread increases to twice the value of the credit received. Okay. Now, things you need to keep in mind are you want to use the same credit strike width when you roll a spread, and you want to and you want to try to increase the maximum profit that you can achieve. So if you were looking at, let's say, a $200 credit that you had, see if you can get up, add another $100 to that. It reduces your maximum loss, obviously, because now your maximum profit achieved will be greater. And I'm gonna see if I have an example I can share here. What was the trade I had up in the beginning? 425, 430. Well, these will be worth less. Let's see what they're worth right now. That's what, October 19th. SPY. Is that October or September?
I thought it said August 19th.
August 19th, sorry. It did say that. Duh. All right, August 19th. So here we are, August 19th. What did I say, 425, 430? Sold the 425s. Bought the 430s, right? Is that right? Is that what I had up there? 425, 430. So these were credited. I put this up, I think Monday. What's today? Wednesday? No, Tuesday. I put it up Friday. So this credit could have been opened on Friday for $75, right? And right now it's worth 50. All right, so I could buy this back for a $25 profit right now on this trade. What I was looking for, I was hoping that this would have gone in the other direction because I'm going to show you how we could roll it out. But in essence, what you do to roll out a trade is you basically close this position down, close this thing down, and select a, what was it, August 19th? That's maybe a couple weeks out. You have to go search and find credits, amount of credit that's greater than the amount of money that you're going to have to spend to close the current credit spread that you got run over on and you're trying to roll. Does that make sense what I just said? So if you have to spend, let's say I open this for 25 bucks for credit and it's now at 50. All right, I got to buy it back for 50. I want to make sure I find a credit that is at least equal to net what I sell, at least net equal to make it greater than what I originally had. So if I'm going to have to buy this back for 50, it cost me basically $25. So I'm looking for $26 or above to get as a credit to make up the difference, so that I'm back to where I was at net even. Ideally, I'd like to maybe add some to it since I'm going further out in terms of time. I'm actually hoping I can add a credit to this. Make sense? Are we almost 2 hours into this thing?
Almost, yeah.
You have 15 more minutes.
All right, so mistakes. I've had a few strikes too close to the underline. That's, we talked about. Is that a mistake? Is that a mistake? Maybe. Depends. Choosing too wide of a spread. That I think is a bigger mistake, to tell you the truth, because I think you can get plenty of credits out there without having to use a lot of buying power and having this maximum potential loss that's in there. Too high of a delta, once again, it's a matter of an opinion, it's a matter of strategy. For the ones I'm teaching today, 45 days out, stay outside the expected move, you're probably going to be at a 25, 20, 18 delta, somewhere in there on the short side. But you also got to pay attention that you're not getting too low of a premium to make it worth the trade. 1/4, take that as sort of your guideline to start with. Anything under 20% of the spread difference, unless you're playing something really short. When I say this, I'm talking about within a time frame of 45 days. Under 1/4, it's not worth the trade. On a day of expiration, I don't know what you do on that on your 0 days. Why don't you jump in ARAX? What do you get for your percentage spread on the spread?
On a 10 with on SPX, I'm looking for 20 plus.
On a day of expiration,
20 plus.
you're getting 20. You're getting 20. You're getting $200.
$20.
$20. Okay. So what is that percentage wise?
2%.
2%. Okay.
On a 5 or less delta.
Okay. So
That's how volatile SPX is.
Gotcha. Well, you're learning how to trade it very well, from what I can see. What's that?
No, but as you can see yesterday, I got in at 25, and then it went against me to 40, and then another one at 80, and I managed to close it all for 10.
Not bad.
Oh.
Not bad. You scaled. You scaled though.
I put in all these orders like all at once, tiered. So like if I get fucked here, 40. If I get fucked here, 80, and that's it. And then I just let theta do its work.
Gotcha. So short-term expiry, unless you understand how to manage it correctly, which ARAX has started to master because he's gotten into that lately. He's been day trading these, and it's a day trade. It's not a scalp. You're not going to get a move in a scalp period of time. Which scalp period of time is, to me, less than 10 minutes. What?
Today, yes.
Okay. But but it's more of a day trade, right?
Yeah.
Yeah.
But
okay. So, but anyway, what I'm looking for is 1/4 of the spread for buying power, right? 1/4 of the spread for the credit I'm getting on the trade, because we're 45 days out. I'm looking for that time value. So a great income producing strategy, higher probability of profit. You risk losing much more than your maximum profit on the trade. Of course, that's different the higher the delta you go. So the way I always thought about this trade is owning a slot machine where you just get a lot of little money gets piled up every day. Then once a week somebody hits the jackpot, and your losses are 2.5 to 8 times the maximum profit you could have achieved. So that's sort of the good, bad, and the ugly. I like it for continually earning income, which is why I have these things always out there. 45 days, and 21 I'm looking to move the money else, move the buying power elsewhere. So I think personally, I think it's a great strategy. It clearly puts you very much in the same shoes that a market maker is in. That's it, guys.
I'm looking at one that might be a good, like, if somebody wants to test the theory. Look at Google for September 16th. I don't know if A-Rex might think it's too small, but I just thought if somebody wants to learn, look at Google for September 16th and sell the 125 and buy the 127. I know they're getting sued by the federal government.
I'm still waiting for tomorrow.
Yeah, I wouldn't do it until tomorrow, but
yeah, tomorrow's an event risk. Probably one of the biggest event risks we've had in a while.
But I know that Google's getting sued by the federal government. So
they always get sued.
Yeah, that's true.
What's the strikes?
I'm selling the 125 and buying the 127. So I have that 5-point move, I guess, or well, it's $2 total move. 125 you sell it, and 127
$50. Lose against you're losing 150. Yeah, that's a decent trade actually.
Ooh,
well, you don't like that one?
I like it. Pending
tomorrow. I mean, you're only talking. Your maximum. You could put 10 of these up here.
Yeah, so that's what I'm saying. You're risking $1,500 to make $500.
Right.
So
right, that's a decent trade.
And if you look at the P50, it's 85%. So it's
No, I like this. I like this trade. So, is there enough liquidity there? Not really.
Well, I think Google usually I would have said not enough liquidity, but I think now that their stock price is like 125, 127. This right now it's 117 today. So I think.
What's the OI on that 127?
What's the what?
Open interest.
Open interest.
Oh, I got to go to a different screen. I don't see it on here.
Tasty doesn't have it on here. I don't know why. I thought these.
Yeah, I have a volume. I mean, if you look at the 125, it's 371. If you look at the 127, it's 33. I mean, if you want to be really gutsy, go to the go to the 130. I mean, you're gonna make that's still 33%. Look at that.
I'll look at it.
It's 95 to 405. I mean, you make $95 per contract.
The only complaint I've ever had about playing Google always was liquidity. That's why I was asking that question.
Looks like September 16th. So
125. What's the OI? I don't have that.
On the 125s?
Yeah. Probably decent.
Ooh, 11.9K.
Okay. And what about the 127s?
1.9K.
Okay, there's no volume on today though, but
I mean, today was risk off.
What's the other one? I've got GOOG. What's the other one?
The other GOOGL.
GOOGL.
Are we talking about Class A or Class C?
I play the GOOG, so I play the Class C.
What did you say? Which ones were the ones you're looking at? Why is it $109 on here?
125, 127.
125. Okay, so here you got more liquidity.
Is everyone playing? Yeah, Class A, Google.
Here you got much more liquidity. GOOGL.
Oh yeah.
That's what I have.
And still, you're still. What is that? What 42 to 158?
Yeah, you could slide that maybe. You might be able to maybe get it up here.
What's the delta width on this? 6? Oh shit.
125, 127. Oh, it's 2. Oh, the delta width, yeah.
But
I mean, look at that. Your max loss is 155. So you could buy 10 of these, and you're at 1,500, and maybe get the credit up here, closer to here. This is a nice trade, Jeff. I like it.
Ending.
I like it a lot. I'm gonna have to make a note of that.
So I'll be watching this one tomorrow, and it looks like this. If you look at the bottom right now, it says 37 cents to 48. Yeah,
Right.
$37 to $48.
Right.
Watch the
42
market.
cents.
Watch it go to complete trash because the market just crashes because of high CPI.
Yeah, I'm also wondering after
Oh.
hours how accurate these the bid ask is. You know, it's just like because you know how stuff gets wider right away, right near the end of the market. You know, the
Mhm.
bid asks always get wider. Maybe it might be narrower tomorrow.
I just thought this one would be a good one for somebody to try. You're risking $158.
Something similar,
Yeah,
not the
150.
same
Yeah, risking that. This would be a good one to try, and you're inside the expected move a little bit.
Yeah,
Um,
barely. I mean,
barely.
and
What's it
I mean,
trading at
could
now?
they go there? Sure, but I mean, Google's been getting beat up lately. I mean, just literally getting. They couldn't stand up if their life depended on. Ever since they did their stock split, they have not been able to stand back up.
Depends.
Look at the daily here.
I'm so risk averse right now. And that's why I switched to zero DTEs.
Well, the market is kind of a risky place to be, right? So here's your.
Well, that's why I stick to my scalping right now. It's just because I know that I'm in and out. The only time I got really mad was when the VIX and the SPY were going in the same
Yeah, I
direction. I
know.
was like,
You left for the day. You left the
oh,
building.
I was pissed.
Jeff has left the building.
I have left the building. I got irritated. I was like, you bastard took my money. You tricked me.
Well, this area of Google right here has been stuffed now up over and over and over again since it tried to get there in May. So that's a pretty good spot for it right now. I'm thinking in terms of hitting a resistance area. And maybe if it pops to 120 tomorrow, you know, put your alert right there. Maybe get it at 120. Maybe get that spread for, 60,
Way more.
60 or 70. You know?
Yeah, but it's still. But your the actual value of the money you'd be tying up would be less, though, right?
No, well, yeah, because you have a bigger credit. You subtract that from your
Yeah.
from the spread. So the spread is only 2, right? Isn't that what it was?
Yeah,
Right.
it's a $2 spread. Yeah.
So $200 is your spread value, right? And you subtract whatever credit you get from that. So if you could get 80,
So the buying power just
now you got a max loss of 120. So 1,200 on a 10 spot. Max. So yeah, I mean, like I said, there's no, I think the biggest mistake I've seen people make on these trades is by going too wide. On the spread. I think that's probably the one mistake that I would point out is most common and easily avoidable, and not necessary to put that risk on the table for the credit you're getting.
Which is why like my max width is always 10, no matter what.
Yeah, I mean, you could do that. It's tempting to do that. Go, oh, look what I did here. Look what I did here. But now you've got all that room in between the short and the long.
Yeah, just size up more instead.
Right. Exactly.
Yeah, that's what I was going to say. Just size it up.
Right, exactly. Size it up more instead of doing that, because you're just taking on unnecessary risk. So, gentlemen,
Well, this one,
I hope this helped.
This one I'll keep on schedule tomorrow.
I hope this helped.
Help me.
Yeah, thanks. Thanks, Richard. Thanks, everyone.
Okay,
The
so
main reason I wanted to learn this was
Yep.
simply because I don't always have time to watch my trades, and I like to be a scalper too.
Mhm.
Especially now with the new baby. I kid you not. There's been trades I lost because she cried at the wrong moment, and I had to go my wife and stuff. So I would love a strategy
nothing
where
worse
I
than
could-
blaming the kid for a loss. Eh?
It's funny because I was talking to Richard today, and I was in a Tesla trade, and I said, I'm going to hold it till 841, and then I said, okay, I'm out. And Richard goes, I thought you were going to hold it till 847.
Yeah.
847. I said, oh, dude, I'm working on a project, and I can't keep my mind on it. So I don't like to be in a trade if I can't watch it. So
Let's take a look.
now
at
on
this.
these right here, I'm using the AREX theory. I can sleep in.
Listen,
So
these trades aren't that hard to manage, and you can use brackets too. So I mean, if you want to put a stop loss on it, you can just put a stop loss on, and for the day, right?
or how much conviction do you have in your levels?
Right.
That's also important.
Yeah, I
Like
agree.
me. Oh my god. It went against me $40 and I still made up with profit. I'm still surprised at that.
Here's the futures right here, up a little bit. Up a little bit. Nothing's good to sing. I don't see this. I think this will probably be one of the flatter Globex sessions you're going to see until 7:30 tomorrow morning.
Yep.
Then we're going to see fireworks, just like we did last Friday on the BLS report. But remember the BLS report came back from that too, though, from after getting
Hard.
hammered. Came back really hard. So
We broke 4180 on SPX. That scared me.
that was a big move.
And then it moved down against me. Piece of shit.
So I'm going to stop my recording.